Welcome back. You're watching Stockwatch with me, Simon Brown, and joining me to take your stock-related questions tonight, David Shapiro from Sasfin Securities, Wayne McCurrie from FNB Wealth and Investments. We are pre-recording the episode, but do continue to send through your questions or email stockwatch@bdtv.co.za or SMS 41392 or on X using hashtag StockWatch. Gents, thanks very much for your time today. Let's jump straight into some of the questions. I got one or two on Twitter, or X as they call it. Advitech trading update earlier today. Wayne, let's start with you. I mean, not a bad update coming from the school supplies. We saw not bad numbers from Shapiro either. And the question is, which is a preferred of the education stocks on the JSE?
Look, I mean, I must say the numbers weren't bad at all, and certainly Shapiro wasn't bad. But I like Advitech. You know, it's higher up the food chain. You could say, you know, it's not just school. It's not school education. It's secondary and tertiary education. And I actually prefer that. And I think if you look at their numbers going back a number of reporting periods, they're probably on average a bit better than Shapiro. So I would go for Advitech. But there's nothing wrong with Shapiro. You know, it has disappointed a little bit, I suppose, when you hark back to the glory days of Shapiro and private education. Yeah. But I prefer Advitech.
Advitech, David, your preference of the
Same thing. You know, it's just a steady accumulator or steady compounder. And I think if you want proof of what Wayne is saying, just have a look at the chart, which just moves in the right direction. I think we're in new high territory. I don't know exactly today whether it's the all-time high, but it's in that territory, and I think it just continues to grind up. And you've got a nice proven track record. So it's one of the better companies on the JSE. You know, it's not easy to get large parcels of it, but still, if you're looking for a good performer, you're not going to go wrong there.
Yeah, no, I agree 100%. Advitech's my preferred. I hold it, and it was trading just off all-time highs when I left earlier. A question coming through from Joel around ABSA, wants to buy and hold for a long period, attractive dividend yield. Question is this good advice? I mean, David, let's stay with you a moment. I mean, our banks have run since we had the election back in May, but they're still not massively expensive.
No. I think all our banks are relatively cheap. There may be reason for it. And I know Wayne's chosen ABSA as a stock pick in the past. And it's a solid, good bank. I can't fault it. I think, Simon, there's one thing that concerns me, and it's got nothing to do with the government and national unity. When you start to look at unemployment numbers, and then I look at Northam's results this morning, there's still a lot, and I'm referring also to Supergroup's results 1 or 2 days ago. There's still structural issues here that we've got to sort out. You know, it's going to take time. You can't will this away. So I think a lot of work has to be done, and for me, it's a bit of a concern that having looked at Sasol's another one, Northam, you know, all those mines, we've got work to do. And against that, it's very difficult for a company like ABSA to do exceptionally well and grow fast. But it's solid. You know, I can't say anything more than that. It's a solid, good business. Yeah,
Wayne, that's a good point. I mean, they operate in a really tough environment, but they've been operating in a really tough environment for a decade or more. Your take, Wayne, on the banks locally and a preferred of the big ones?
Look, the big ones, I would go for Standard Bank, I suppose. I mean, I can't push my own company, even though I might get into trouble if I don't push my own company. But they're all looking very, very cheap, even with this bit of a run we've got. I mean, ABSA in particular looks cheap. I think the dividend yield is higher than the price earnings ratio, which is normally a sign that, you know, either something is fundamentally wrong or the share is just cheap. But they're all cheap. I suppose my preferred one, as I said, is Standard Bank. ABSA, clearly there are some issues there, but it's all in the price, I would think.
Yeah. David, you kicked open that door, Sasol. We had the production update a couple of weeks ago. That didn't look too bad. That's what they can manage. We had the trading update earlier this week, Monday, and they have been writing down things left, right, and center. One of the questions on my Twitter was, is there value in Sasol? Now, Twitter would tell you there's a ton of value in Sasol, but the market, the price action, maybe less so. David, Sasol?
You've got to look forward. And looking forward means we're going the next 6 months of this year, and from then on, we're going to get a better global economy in which perhaps demand will pick up, commodity prices will pick up, particularly chemical prices. They've been hurt, and they've been hurt very badly by decisions in the past where they've overpaid. And that's, yeah, just on the write-downs. Yes, this is cash once spent that is on which you're not going to make a return, but that's already in the share price. The share price corrects for those impairments. All that the company does is bring its balance sheet in line with what the market has been saying. And I think it comes back to somewhere down the line, we're going to start to see the bottom of this so-called commodity cycle. Just be patient on it. But to put it in a nice, neat way, I think your downside's probably a lot less than your upside, if that makes sense. In other words, I think there's more upside to be made than perhaps downside at these levels. And I refer to BHP, Anglos, all of those as well.
Wayne, Sasol, I mean, it's had a tough time, but as David says, I mean, the write-downs were cash on the way and they're not on the way out. It is them, I suppose, right-sizing the group in some ways.
Yeah, look, I mean, all they're doing is these are accounting entries to get the balance sheet down to what, at the moment, I suppose the anticipated future profit they can make at current chemical and oil prices. But, David and I often discuss this. It's real money that was once spent that they're writing down. It's not just an accounting entry, it's real money. And I mean, this is not the first time they've written down Lake Charles, which was by far the biggest write-down. It's happened quite a few times already. I mean, I don't know the total they've written off on their American adventure, but it must be 80 to 100 billion. It's an enormous amount of money. But it's in the share price, as David said. In the middle of 2022, this share was $400. Now it's 120, 130 sort of range. We certainly see fair value up to about 230. But if chemical prices turn on the back of lower interest rates and some sort of global economic recovery, the upside is big on Sasol, as David said, the same as a lot of other commodity companies as well.
Yeah, absolutely. And I was trying to remember, I mean, because they did an earlier write-down on Lake Charles, now they've done another one. I don't know how much they've written down, but another massive, I suppose, misadventure.
I think, Simon, management can always say, it wasn't us. It was someone else.
And it was a catastrophe. I mean, that was just an unmitigated catastrophe.
It was. But I take your point, David. It was always the earlier oaks. So it was never us. It was my predecessor. Let's stay with gold miners. Certainly, we've got gold up at around 2,500, trading around those all-time highs again. Wayne, your preferred gold miner, local or offshore?
Look, I'm not a big gold person. I never have been. So I wouldn't be buying gold shares now. I think there's a big chance of a downside on these shares. But I suppose it's difficult for me to actually pick a gold share, but I suppose I'll go for Anglo Gold.
Yeah. David, I mean, certainly the gold stocks have done well. Gold has done what it says on the sticker, whether it holds or not. Because if this starts going south, those miners are going to go in a heap.
It's so difficult. I mean, there's so many variables. It's very, very difficult to decide. I just watch it from the side. That's why I prefer the diversified miners, where I think there's a much clearer view of where they're going. Gold is difficult, and gold price at a high now. Does it hold these levels? We don't know, and the results haven't been all that astronomical. They've been okay. So it just shows you the difficulties. I was looking through Goldfields as well. Funny enough, over a 10-year period, Goldfields is still one of the best performing stocks on the JSE in dollars. And yet, if you look at the last few years, it's been a disaster, like this year. So I don't know. I'll stand back as well. Okay. Gold's not an area that I've really been involved in at all.
So you both like diversified miners. Which would be your preferred diversified miner?
I think BHP at these levels, even though it's been down as well, I think it looks pretty cheap, and they've got lots of muscle. I know they've also been writing down things and so on, but the issue is also on iron ore. Iron ore is now flipped below 100. It's at 98, And then you always hear the callers, oh, this could go back to 80, which it never really does. But you've always got to leave the option open that it might go down to 80 if something happens. Those markets are so unpredictable. If that happens, I think there's going to be a lot of stress on Anglos, on BHP, on Rio Tinto. I think Glencore's has least exposure in that. But that iron ore price, I don't know. It's around 100. I would back it to stay at these levels, but there are voices out there that see it lower.
Yeah, well, and Kumba's coming under pressure today as we change. Wayne, your preferred diversified?
I agree once again with David, it's BHP.
Okay. And then, I'm taking from what you're both implying is that Kumba not, because I'm looking at Kumba as we're recording, it's almost 6% lower, but it is iron ore and it's a single commodity. Wayne, single commodities are nice when you're on the right side, but it's harder
when you
to
get
call.
It right.
Yeah.
It's obviously very hard to call, yes. And so you can get it right, and obviously I've been talking about platinum. But generally speaking, these are, you hopefully buy them at the right time and then you sell them. These single commodity companies are dangerous.
And it's the selling part that I often forget.
You've got the added issue of shipping the stuff to the ocean,
Yes.
Getting it down to Saldanha. And there have been plenty of issues around this. They're getting there slowly and lots of negotiations, but it's still a problem. It's still a big issue in South Africa, the Transnet side. So you've got to factor those in as well.
Yeah, and Transnet's not going to fix overnight. We see the same problem with the coal miners. They've got to get it to ports, and that in of itself is a challenge. Around tech stocks, we've got Nvidia results in 2 weeks' time. Question, David, was really quite simple. Do you buy before the results, at the results, or after the results?
I can say you can buy anytime. It doesn't make any difference. I'm still expecting good numbers from Nvidia, and I still like the theme very much. And the more you read into it, the more you understand what a dominant position they have and how much money is being spent there. They've tried to batter it. There've been plenty of short selling and plenty of bashing, and it's back to 115 now, which is still a very healthy price. I think up 135% on the year, but it's not a Cisco, which everybody tries to compare it with at the in the early 2000s. This is a business that's ahead of its competitors, making a lot of money in an area of the market where spend is taking place. Mm-hmm. So I still like the company. It's rich, it's gone up a lot, but I still think it's going to get a second wind.
Wayne, your take on Nvidia? Certainly the high flyer. The last couple of weeks it came under some pressure, back under 100, but been moving again.
Yeah, look, it's certainly better. I do agree with David longer term. Maybe we do get a bit of share price weakness now, but it's better to buy it at 110 than 140.
It's true.
Yeah. No, and the market's giving us that opportunity to get it at 110 rather than the 140. Bringing it back home, question come through. Clicks versus Dis-Chem, either or perhaps neither. Wayne, let's start with you on that one.
It's a hard question. I still like Clicks. I know the Clicks share price looks expensive, but it always looks expensive. They've been extremely good over the years. Dis-Chem's also a good company. Make no mistake, but I prefer Clicks. And
there is, Wayne, you say it's expensive, and you make the point it's always been expensive. There are some stocks that you simply have to pay up if you want to own them. ShopRite's another one.
Yes, I agree with you there.
David, Clicks or Dis-Chem?
I'm a Dis-Chem person because I find whatever I'm looking for there. But you can't take anything away from Clicks, and it's spread throughout the country, and its track record. I think it hasn't let us down at all. I'll go with Wayne on this one, on Clicks. But I enjoy Dis-Chem, and all my old mates are there in the line, going in for their prescriptions.
Their prescriptions.
You meet a lot of people,
Their prescriptions and their protein.
Yeah, we've said this before. There are 20,000 Shapiro shopping at Discount.
You got to believe it.
Yeah, I try and stay away. What I can never get is they sell you all these healthy things, and in the queue to pay, there's the chocolates and the sweets. It's like that disconnect.
I know. That's the best part of clicks. I mean, of this game. Yeah.
David, let's stay with you. What about local clothing retailers? Again, we've seen them run. Mr. Price had a good year. Foschini's been moving well. Have you got a preferred in the clothing retail space?
I like Foschini. I must say, and you can notice management. You can notice the change in management. And what I mean by that, it comes through in the stores. And I know this is not clothing, but they've got the at-home as well. And there's a massive upgrade in the quality that they're doing and their generally their merchandise at home. I like where Foschini is at the moment. Yeah.
Wayne, your preferred?
I think it's a good operation. Yeah.
Wayne, your preferred in the clothing space?
Well, I think next week we can just have one of us on because we keep agreeing with each other. Yes, I agree with David on TFG.
Yeah.
Because they don't like it when you call it Foschini. You got to call it TFG.
Yeah, that's right, TFG.
They get quite worked up about it for whatever reason. But look, you must not underestimate the effect that this two-pot retirement system is going to have before the end of the year or the beginning of next year, whenever. It's going to be a significant amount of money that's going to come into consumers' hands. And as we all know, it's just going to be spent. So the clothing people, the retailers, maybe even some of the building suppliers are going to benefit. Build It and Cash Building, etc., could also benefit from this. But the number is going to be big. I mean, I think 98% of people you get that second pot are going to pull the money.
Yeah. I mean, I've heard numbers of around 40 billion that will come out by the end of the year. Staying with the two-pot, Wayne, and staying with you, a question came through in the emails from I think it was from Joel, asking around the two-pot. And he says, is this a good or a bad thing for banks? And the one thing, maybe it's a good thing because people might use some of it to pay off a credit card. The flip side is it may be a bad thing because people won't need their credit card or any loans because they'll have their two-pot money. Are you looking at the banks and the two-pot, or do you think it's going to be largely a non-event?
Largely a non-event. People aren't going to take, I mean, unfortunately, which everyone should, they're not going to take that money and pay down their credit card and pay down their housing bond, and that it's just going to be consumed. So they'll still need their credit. They'll still need, it's just over and above whatever's got now. It's just, unfortunately, going to be blown. And I mean, I understand the logic behind this two-pot system. It stops you from leaving your job to cash in your pension fund in emergency. But that's still going to happen because people, when you get a windfall, as I said earlier on, the majority of the people are just going to blow it. And then when they hit an emergency next year or 5 years' time, they're going to resign to access their pension fund again. But this time around, they can't do it, though.
Yeah.
This time around, if you access the second pot, you can only do it via an annuity. You don't get a payout on it. So maybe that is off the cards now.
Wayne, two pots in banks. I mean, I think Wayne's right. People are going to spend it. Sorry, David. People are going to go and spend that money.
Yeah, this is lottery. They're winning the lottery, and when they see that balance in their bank account, the temptation, to spend it is great. And I think it's going to go exactly where Wayne, it's going to go on clothing. It's going to go on everything, all on consumables. So I would expect Christmas is going to come early and it's going to continue for a long time for our retailers.
Speaking of retailers,
as long as it doesn't go to Hollywood bets, that's all.
Oh.
That's all I'm worried about. Is that
I take your point on that. Yeah. What about Lewis? Boring. The comment is a boring share, but good yield and massive share buybacks. I actually had a look at the share outstanding chart recently, and it's one of those ones that goes from top left to bottom right, which the only time you want to see that is in share count. David, Lewis, a nice little business. I mean, they're kind of like a bank that sells furniture.
Yeah, because of HP.
Yeah.
It's always been. This was great Universal Stores. Which was a well-known global retailer, and they've always just done that. I haven't looked at it for some time, and I think it will be it will be swayed by whether or not consumers are spending. And I'm not sure whether they go for those ticket items when they're really strapped for cash. It's more food than that. So I'm not, not having looked at it for some time, I'm not quite sure. But as an operation, yes, they had the issues. Remember on the insurance side and problems like this, which they've now sorted out. But I can't fault it as an operation. I mean, the economy might be against it. Yeah.
Wayne, Lewis stores?
Yeah, look, they should benefit as much as what anyone else will on this two-pot system. But generally speaking, I mean, maybe we've been too tainted by history in South Africa. I don't really like the big furniture credit guys. They get into trouble every 5 or 6 years, and they get bad debts and something goes wrong. And so, yeah, look, I mean, it's not a bad operation, but it's not a company I would jump at.
Yeah, I take your point. And I remember, back in the day when we also had Ellerines was listed and JD and all of those were also listed. Yeah. And it would be great for a long time, and then suddenly it wouldn't be so great at all. A question coming through to the point, we're talking around the two-pot money being spent. Surely this bodes well, David, for the likes of the Spurs and the famous brands as well. We're going to go out and have dinners and celebrate because we haven't been out for ages. I
think anything on which consumers will spend, where consumers will spend, are going to benefit. And surely that. I think it's going to be a bonanza for for the whole retail sector. I don't think you can differentiate. It's whether it's ShopRite, whether it's Spur, whether it's Foschini, whatever it is. I think they're all going to get some share of that pot.
Wayne, quickly before we go to stock picks, Spur, famous brands, would you have a preference there, or is it a case of we're going to eat at a bit of both?
I actually like both of them. I'll probably go for Spur, to be honest. They got nicer onion rings.
I thought you were going to say they got no debt, but they do make good onion rings. So I suppose we can't argue for that. We've got a couple of minutes left. Let's go for the stock picks. Wayne, you're going with Intel. They've had a tough time. I mean, this is a stock that's been around forever and a day. I think they were the ones who were doing the big layoffs. Tell us the story behind Intel.
Yeah, look, I mean, obviously they're hitting tough times now. That last set of results that came out, the share price got absolutely thumped. But it's a true turnaround value type share. I mean, this is at a share price low in the last 5 years, I think. Mm-hmm. And I mean, obviously, you open up your computer, there's a little tag there that says Intel inside. Yeah. And I can only see demand coming back. They're going to cut costs. They're going to resize the business. So yeah, maybe a bit of a although you can't call it a value play given the price earnings ratio, but a bit of a recovery play.
Yeah, and there is, I think, also a lot of computers were bought during the pandemic. There were a lot of pull forward. Those are now getting 4 or 5 years old and are going to be needing some replacing. And I'm looking at the laptop. Yep, Intel inside. David, you're going with Costco. Now, they're the weird ones. They charge you to shop at their shop.
They do, but I mean, they've increased it's like macro. You get a card, you get a macro card and that. And what they've done now is that you can't lend it to your mates. You've got to register for your own card, so you can't do the Netflix story. Even Netflix stopped it. But why I like it, first of all, it's a superb operation. But I also think it's going to get a similar bonanza that we've been talking about now. Except this is going to come from the reduction in US interest rates. And I prefer to go for the retailers, where people are going to spend the money rather than trying to work out, are they going to buy, what beer they're going to buy. And I say that having looked at Carlsberg's result this morning, it's very tough now to do the marketing that you used to do in the old days when you had television and that. You're now competing against TikTok and Instagram and all those. So I think the way to benefit is through the retailers, Walmart, even Amazon, Walmart, Amazon, and Costco. And that was Charlie Munger's favorite company. And I can understand why.
Yeah, and they do a hot dog for $1.50, which apparently has been that price since the 80s. And weirdly, they're one of the biggest sellers of gold coins in America.
I didn't know that.
Because you can go to Costco and buy a gold coin. So, I mean, why not? And in fact, you
Don't
can
buy it cheaper.
no, they sell it to you at spot, but they've been this year, they've done huge numbers of gold coins, and it's completely wild. But anyway, that's it for tonight's Stock Watch. Thanks to our guest, David Shapiro from Sasfin Securities. Here, of course, going with Costco, listed in the US, and Wayne McCurrie from FEB Wealth and Investments. His pick, Intel, also US listed. Up next, the close. Stay tuned.